We live in a world of highlight reels. Stocks that soared, portfolios that beat the market, overnight success stories. But what's often missing from those stories are the sleepless nights, the volatility, the gut check moments. Reward gets attention while risk gets ignored until it's too late. Let's talk about what risk is beyond just the ups and downs of the market. Risk could be selling at the worst time, taking too little risk and losing purchasing power, taking too much and watching a dream disappear. So the question is, how much reward can you afford to risk? Every investor has a different capacity and tolerance for risk. Some can ride out the storms while others need certainty. Here's the key distinction. Risk capacity is your financial ability to ride through a downturn. To put it simply, it's your ability to watch your account go south in value day after day for whatever period of time the market is going to go on a downward route. You have to consider your timeline, cash needs, and income stability. Risk tolerance is your emotional ability to stay steady when things get uncomfortable. And those two don't always match. People can even overestimate their tolerance until the market drops. To approach this, let's start with the question, how much reward do you want? The answer is basically always more. That doesn't help us very much. A better starting point is how much risk can you tolerate and how much risk can you afford to take? Let's make it tangible. So you've got $1 million in a high growth portfolio. A strong year, that takes you to 1.2 million and you feel great. But a rough year drops you to 600 or 700,000. It could be life-changing depending on your situation. We don't get to choose which kind of year the market hands us, and down years are simply a part of investing. The takeaway is this: we don't set risk based on reward you wish you could get. We set risk based on the downside you can realistically live through, financially and emotionally, while sticking to the plan. Beyond being brave or conservative, it's about aligning your investments to reflect your goals, your values, and timeline. Not your neighbor's portfolio or the guy beating the market on CNBC. That's why the risk conversation is non-negotiable. It's not a one-time decision either, because your life changes. Your timeline changes, your cash flow situation changes, and sometimes your tolerance changes too. So the goal is to keep your portfolio aligned with what you're trying to accomplish and to a level of risk you can stick with when things get noisy. Because managing wealth is about both growth and protection, so you can stay confident through uncertainty and truly sleep well at night. Risk and reward will always go hand in hand. The key is understanding what kind of risks make sense for your life, your goals, your peace of mind. That's the difference between chasing returns and making intentional, long-term decisions as a steward of your wealth. Thanks for watching this video. Subscribe and follow for more.